Welcome, everyone. Welcome to the Hurley Investments market view commentary for the first day of March, Monday evening, 2021. Today, we're going to go over and recap what's happened last week, some stocks we're looking at, and our current positions that we're in. I'm also going to go over where I'd put new money to work if I was putting money to work today or most likely this week. So, short answer, last week, pretty good drop in our market, roughly 2.45%, or it lost about 60% of the downward movement. The market was up 2.6%. Let's just face it, last week was a ridiculously bummer week. Yes, we had a monthly gain, but we erased half of it basically in the last week, and there was next to no gains in January. If we go to what is prompting the drop, right now we have bond yields. And I call BS on bond yields being the reason. It really comes down to the worry that the Federal Reserve could boost rates sooner than expected. How would I say this? Powell doesn't have that strength behind him. I don't think they're going to boost rates. In fact, if anything, historically, Democrats will keep rates lower longer to really help the everyday citizen. So I wouldn't think that we're going to have interest rates that'll boost higher. The biggest sector, the largest drop last week was utilities, down 5.1%, followed by 4.9% consumer discretionary, and a 4% slip in technology. You would have thought that technology would have been your biggest loser, right? You would have expected that with all that you heard from the NASDAQ and how much the NASDAQ dropped, the technology would be horrible. The reality is utility sector, because of all the expenses with what happened down in Texas, ended up being truly the biggest loser, and people saw through that. Not much there, but I found a little interesting part of the Bloomberg's what's happening. Yields are down. So this was just for this morning. Global bond markets are stabilizing after last week's rout as central banks across the world reassure investors that they will continue their accommodative policy measures and/or not raise rates but keep it low. While officials at the Federal Reserve and Bank of England have said they see little cause for concern in the rapid run-up in yields last week. Australia's Monetary Authority still would stick with the yield target. The European Central Banks would not tolerate higher yields that risk undermining the economy. Increasingly, investors are reassessing the risk of a breakout in inflation, with now some thinking fears the rapid increase in consumer prices are overblown. So that's the technical term. Let's put it into plain English. Last week, we couldn't find a reason why our markets were tanking. Mathematically, there was nothing that would show you that there is a reason to be worried about our markets. Interest rates were going up, and comparatively speaking, it was like a 20% rise in the 10-year, but it was 20 cents on what, $100? 20 cents on $100. It didn't make sense. So what you saw last week was some repositioning of firms thinking, okay, interest rates are going to go higher. The Federal Reserve and Bank of England can't stay with their lower rates for longer. So you saw some profit taking. We will probably see something very similar to what we saw last week, but it'll most likely be somewhere between a 7 to 10% drop when you see people worrying about the higher tax rates that the Democrats should push through the House and the Senate and get signed off in the near future. In fact, I haven't read it yet, but I saw an article on how the Democrats want to tax the ultra rich. I don't know what those are yet, but it'll be interesting to see. With that said, I kept one other little thing in here that said stimulus. President Joe Biden's $1.9 trillion stimulus bill, which was passed by the House on Saturday with no Republican support, moves to the Senate, plans to penalize companies that don't raise the minimum wage, have been shelved, thank goodness, in order for the package to quickly progress according to people familiar with the matter. With some employment support measures running out in 2 weeks, the focus on lawmakers is to getting the bill passed to the Senate and ready for Biden's signature as quickly as possible. I'm just going to make this comment. If the economy is recovering because Trump's not in it, and our expectation is people are going to go back to work, we've got the vaccine where we'll have we'll have herd immunity by May. What do you guys think? Do we really need another $1.9 trillion of stimulus? I'm not sure I see it. Do we really? Well, let's put it this way. We still have hundreds of billions in small business loans left over from last time. Why can't we still push that through? I'm a little at a loss for words right now. A couple comments just came through, but I love this one. No, especially with all the pork in the bill. Our first bill had what, $368 billion for us, almost 600 for who knows what. Man, vote them all out. Vote them all out. Not there, not needed. Let's take a quick look at positions I was looking at for the near future and our current positions. I was thinking some of the stocks I'd be looking at this year were Walmart, something I haven't been in for a while. I think it's best positioned for continued growth as people can get out and back to shopping. I think they're doing well in their online business. As we look at it, it's not doing well. In fact, it went back to July, August, and September lows. Just looking at Walmart, if it gets down to the 120 range, that is your buying opportunity. You might see us put some money to work down at 120, maybe 125, but 120 is a definite. You pull the trigger and you buy. On the flip side, Target was another interesting one. And they're kind of going through the same thing. 180 could be the trigger to buy for Walmart, but the definite trigger, if it gets down to 170, you're buying Target. Costco's an interesting one. Costco is one I would just do at a leap call. And if you're looking for a trade, a 2-year leap call on Costco right now at the August-September lows, at those August-September lows is where you'd want to purchase an opportunity to run Costco higher. Airlines, I talked about Alaska Airlines. Kevin, did we miss it from 50 up to 65? I don't know. It was a new one, but it was one that I was having a hard time looking at in December. And when it pulled back in January, it fell off my radar. So, of course, the thing then takes off 30%. There is still probably upside growth in Alaska Airlines. It's one that you should consider looking into if you had some surplus money. Starbucks. People want to go out and spend money. Apparently, they like to spend this money. They want to drink it. Let's face it. $100 is where we should have got in February. But again, this is another leap long call, a stock replacement strategy. One that would be a great place to jump in right now is it's holding the 106 support level. If it holds it, you've got a triple bottom and you're off to the races. If it doesn't, you have a triple top and you're looking at 100 to 95 and you're buying in, period, where you want to look to buy in, so to speak. That would be your buying opportunity, is what I'm trying to say, at 100 to 95. All righty, on we go. PayPal. I like the opportunity. It's too expensive. It's too expensive. I don't like where it sits. I don't like the insider transactions. PayPal is off my list as opportunities for next year. It just has gone too far, too fast. I can't calculate the growth. I don't see it with earnings per share of 3.54, next year's earnings at 5.75, and a PE ratio of 77 with a forward P of 47. I can't grasp my hand around where it's at right now. If you take its forward PE with its forward earnings per share and you do the math on that one, taking the 47, second column, second one down, 47.63 times the earnings per share next year of 5.75. It's more than fully valued right now with a 30, well, let's face it, with a 30 divided by 77, with a 38.9% drop in forward earnings, it somehow stays where it's at right now. I think that's why you see the insider transactions selling off. It's they're taking off as much as they can. So I'm not a fan of PayPal. Square, on the other hand, buying opportunity. Buying opportunity, it also has ridiculous PEs and forward PEs. It's a new technology. This is one where you're following the crowd, and 300 is definitely its next upside opportunity, which is about a 20% return from where you're at right now. It's a good buy. Carnival Cruise Lines. I think we have an opportunity. I don't know, and this is not one I'm going to look to get into until after the tax sales. This is a mid-April, May, if people can get back to cruising and getting out. The reason behind it is the comps. It is so oversold. Its comps are awful. Its earnings per share, awful. They will all be easy beats going into next year. Real easy beats. Not only that, look at the insider owned. You still have a good portion where the insiders are not selling. I like where it can get to. If you like Caribbean Cruise Lines, you need to like, or Carnival, excuse me, you need to like Royal Caribbean Cruise Lines. This is 3 times the price. This is probably the better one of the two. It'll have easier comps. It will have better fundamentals. This would be the better of the two. And it really put half your money into Royal, half your money into Carnival, see which one takes off. If we don't have that herd mentality till August, like I think is the time frame, look at MGM. I like it because it's cheaper than PayPal. I think it's better than Hilton, Marriott, all the chains, because it has multiple revenue streams. It's not just a place to stop and sleep. The hotels are nice, the restaurants are nice, The gambling is nice. The online presence is a lot nice. They have multiple revenue streams that give them a great opportunity. Yes, they've already doubled, but they still have big upside opportunity. Low comps, what I don't like on these guys is their insider transactions. People were selling off. Could it be because it doubled already? Maybe. But I think you would have an opportunity here. What I don't like about this one is their debt to equity, but of course they're in real estate. So you would expect a higher debt to equity ratio. If you go through what we are in, if I had money today, I'd put it into 3. I'd put it into Apple. I would have felt better if Apple had broken above its trend line, but I felt around 120 or this morning, 121. Apple's probably going back up to 145. New money in Apple is where I would be looking for opportunities. Disney got beat down, bounced right off of the median line. Again, I would have also felt better if it had broken above its trend line, but Disney has a run back up to 200. If you got in today in the 190s, it's a 5% upside opportunity. And I really like Under Armour. I've waited for Under Armour. I'm going to choose the A shares, UAA. Good opportunity today to get in around 22. 24 is the upside. This is one that can get as high as 35 to 42 by next year. Boeing just sold 25 more shares to United after the market closed of their 737 MAX. There's no reason why Boeing can't head back up to the 250 range, 245, 250. Opportunity for Boeing right now, but I'd probably do Boeing more on a stock replacement than owning the stock outright itself. With that said, it was nice to see Baidu up today. Nice bounce, $12 on Baidu. Ford almost recapturing, dang it. Closed 2 cents below, recapturing 12. Heading back up that direction. Visa, a nice day in Visa today. I would like to see it back up to that 225 range. And that's about what I see. I mean, I would just look for the opportunities in stocks. Someone called me today and said, really, Apple, Under Armour, and Disney. Apple will most likely be at $200 at the end of the year. This is a buying opportunity for Apple. Disney, I can make a case for 300 to 325. You have to stretch the PE ratio above and beyond the low end of Netflix to put it somewhere in the middle, not to mention its parks opening up and its cruise lines opening up. 2 more revenue streams that can come back online. Under Armour. I still like Under Armour. Under Armour has a long way to get back up to break even. Let's face it, the sweatshops out in Asia, the material out in Asia, Under Armour for the next 4 years has an unbelievable opportunity to claim the highs at 42 that it was some time back. It was interesting because people also made a comment to me today, Kevin, what about the banks? You haven't spoken about the banks. And so I got a couple, actually there are a couple Investopedia articles, but the banks didn't do well with stimulus last time. I do think there's an opportunity in banks, but I'm uncertain with the stimulus. It was fun to get new money in around 29 on Bank of America because we could get it up to 35, even 37. So I see that range between 37 and 29, an opportunity to pick up 20% more shares. Banks probably won't move until August. but if I'm wrong, I'm in them. I enjoyed this one because I have a couple articles on how JP Morgan and Bank of America generates most of its revenue. JP Morgan generates most of its revenue from consumer community banking. What does that mean? What is consumer? Provides financial services to consumers, small business, large corporations, governments, and other clients, so they lend money. Corporate investment banks is the largest source of net income and is growing fast. So just keep that in mind when you look at the key takeaways there, because I found it somewhat interesting, although I think that's for Bank of America. But let's just read through and try to understand how they make their money. Consumer community banking. It provides investment products, cash management, payment solutions, mortgage origination, and servicing credit card and auto loans. It loans money out to people. Notice how the mortgage is listed fourth or fifth. Deposit, investment products, cash management, payment solutions, mortgage origination, that's fifth. So there are other areas that it comes up with, and it does pretty well at it. Corporate investment banking, market making, prime brokerage, the big companies borrowing money from them. That's a big portion. Commercial banking, providing our banking needs for companies. Asset and wealth management. It has 2.7 trillion of assets under management. It's unbelievable because when you think about it, it's brokerage banking at its best. Stick your money in our fund, you can borrow against it. We're going to charge you a crap load of charges that you'll never see. It's huge. 14.2 billion on 2.7 trillion. It's unbelievable. And then corporate measures, Myers reports, it's got some other stuff there. This is interesting to see where it's making its money. Abraham, hopefully you're not here, but interesting that they shut down their private banking operations in Brazil. When I was in Brazil, the banks were a little bit corrupt, so it doesn't surprise me. They are best of breed. That's the expectation. They're pretty darn good at what they do. On the flip side, we have Bank of America. Bank of America key takeaways: provides financial services to customers, wealthy individuals, institutions, governments, consumer banking, global markets for revenue growth, yet it cut some of its staff, even though our CEO said it wouldn't. When you take a peek at it, consumer banking is credit. Basically, they're doing a lot of credit cards. That's it. They are doing some residential loans, but the reality of it, they're making the bulk of their money to consumers through credit cards. They do have global wealth and investment. They do their own trading. It generated $18.6 billion, more than JP Morgan. They did very well in their investment banking, their brokerages, retirement products. It's kind of ridiculous. Global banking. They touch base in global markets. And global markets also have in here as well for loans overseas. Please read where these guys are doing it. And then go to Investopedia, and go make a run on Wells Fargo. And you'll see that the majority, 70% plus of Wells Fargo, is completely done, or their income is completely made through mortgages. They have a high unemployment risk to their banking because of the loans that can be foreclosed on. Interesting article, the 50 minimum wage and all that in Biden's COVID relief bill. Please read through this if you want to understand why minimum wage should be a supply and demand. A deep dive into Boeing's earnings. Very interesting article to see where Boeing makes their money. Another article on what I've been saying for years now. And then an interesting article on Apple, the buying opportunities that fell back last week. Really, I talked about this to a couple people. Apple is the one company that can make its own put. It can build its own put into its stock price. Kevin, what do you mean? Well, hey, they've got hundreds of billions of dollars to put into this. They could go to the SEC and say, Securities and Exchange Commission, I want to put $20 million at $200 a share. Excuse me, let's do $100 a share. And the SEC will say, okay, if it drops down to $100 a share, we'll start to use your money to boost your stock price. And that's the price that you're going to buy shares, somewhere between 100 and probably 150 cents. And then as it goes higher and gets up to 150, they'll say, okay, Bank of America, JP Morgan, I want to put $20 billion on 120. And they'll have $20 billion for them to pick up shares if the price falls down to 120. And after another quarter, if it kind of moses around 150, they'll call up Bank of America or JP Morgan and say, hey, the 20 billion I have at 100, put that up at 120 now. So they'll have $40 billion that the stock falls down to 120 and 50 cents, they will be purchasing their own stock. They will create a put or a buying opportunity for themselves at certain levels, and they'll just ratchet up their money so that for all essence, they will be having a put in place where you don't have to worry about Apple going below $120 a share until you see 20, 30, 40, $50 billion of shares purchased at that price. A lot of people ask me, why didn't you protect Apple on the way down? The reason why, because Apple protects itself. Apple can protect itself. You really don't need to protect Apple except at earnings. And for that reason, we didn't put some protection on Apple, and we probably won't until we see it get back up to that 145, 150 range. If I had new money today, I would be putting a small portion into Apple. I'd be putting a small portion into Disney. I'd be putting 1,000 shares into Under Armour. It's just a way to start to build positions based on the opportunities that we have in stocks. If we take a look at our charts really quickly, turning bullish again on the Dow, turning bullish again on the S&P, not quite bullish on the NASDAQ. Technically, it is bearish, but it is turning bullish. Not a whole lot going on this week except for the average work week and ADP reports. Average work week on Friday. Non-farm private payrolls will be looking at under the new Biden administration, and the numbers are getting worse. ADP number on Wednesday, which again is just employment numbers, where we saw new employment into our workforce. Earnings wise, Dollar Tree on Wednesday. Wink, wink for someone that's here watching, but it's the second week of retail sales. We had Zoom that did extremely well today. Abercrombie and Fitch on Tuesday, AutoZone, Chico's, Kiss, Kohler's, Nordstrom's, Ross Stores, Urban Outfitters, Target, AMC. Dollar Tree on Wednesday, Wendy's, Marvel, T-Mobile, Kroger's, Gap, IMAX, Smith & Wesson, Carnival Cruise Lines, Costco, Big Lots on Friday. Pretty easy week. Questions. What questions do you guys have for me today? Or what questions can I answer for you guys? All right, guys, I don't see any questions coming in. You guys have a wonderful evening.